there, good evening. You've joined us right here on this special budget edition of Smart Markets. I'm Taneia, Bhardwaj, and straight to it, where it's been a please all budget, let's just say, as Finance Minister Arun Jaitley has managed to do quite a fine balancing act between fiscal prudence and a demand push. With a clear focus on Bharat, the Finance Minister has allocated big funds for rural infrastructure, even as the corpus for the government's flagship job guarantee scheme, that's Manrega, has now been hiked to 48,000 crore rupees. Remember, that's the highest allocation that we've seen ever. There is some relief for small industries as the tax has been cut to 25%, something to cheer for the salaried as well, as the income tax rate for the 2.5 to 5 lakh bracket has been halved to 5%. But it really was, you have to say, the stock market that seems to have been heaving a big sigh of relief. Markets today saw quite the relief rally, the best budget day move we've actually seen in 12 full years. Both the Sensex and Nifty there on your screen gained close to 1%. Investors clearly relieved that there were no ugly surprises. Remember, there were fears as we got into that event that we could see some changes on the long-term capital gains tax front or on securities transactions. The Nifty today ending in style above 8,700. The Sensex also surging a good 500 points. A quick mention of what bank stocks were up to, and the Nifty Bank was on a tear. It scaled 20,000. In fact, come to think of it, all sectoral indices today, barring IT and pharma, logged in some pretty smart gains. But of course, the question is, will it be this rosy the day after? And what's really led to this extreme euphoria for the markets and is likely to sustain? Well, joining in on the show to discuss just that, Rahul Bhasin of Bearing Private Equity Partners. I've got with me Shankar Narayanan of Carlyle Asia Growth Partners, and Punita Kumar Sinha of Pacific Paradigm Advisors is here with us as well. All three of you, big thank you for taking time out for us today. Punita, let's start with you. You know, no news is good news, as they often say. The fact that we saw no ugly surprises related to the long-term capital gains tax or securities transaction tax, would you say that's why we saw this rip-roaring rally today?
I would say that was part of the rally, the reason for the rally for sure, because I think there was widespread concern that capital gains tax will be removed. In fact, would be levied. In fact, it was reduced for certain types of assets from 3 years to 2 years in terms of the holding period. So that was a positive. So it wasn't just no news, there was a positive news, unlike what people were expecting. And so I think that was one. And second is that, there was also concern about other kinds of taxes that might come in, which did not really come in terms of cash withdrawal tax, etc. And then I think the third thing is that it was, the budget didn't harm anyone. In fact, it benefited most segments of the economy and the weaker sections in particular. Other than the super rich, as defined by 50 lakhs and above, there wasn't really any sector that was hurt by the budget. So all of that definitely led to the rally.
Right. Rahul, let's talk about, the fact that we all agree it's been a fine balancing act for the finance minister. On one hand, the need to stimulate demand. Shankar, this question's for you actually. So on one hand, you had the finance minister who really needed to stoke demand in the wake of the note ban and of course continue on the fiscal part. But there's also been some criticism that perhaps a lot has been allocated for public capex, but very little really for the private capex. Is that a fair assessment? Shankar?
I think this government has been pretty focused in looking at things with the template of what is it that we should do that is in India's interest. And as a foreign institutional investor in India, and we have invested probably more than $1.4 billion or so, we feel this budget is again a step in the right direction. They have exempted FPIs from indirect tax provisions. They have liberalized the FDI policy. I think for category 1 and 2, they have removed the kind of ambiguity that was there, the indirect tax provisions, etc. And I think eventually, in a free market economy, and for probably about 75% of recorded history, India and China were the wealthiest countries. If you see, it was free markets that helped our countries thrive. And what the government is trying to do is to set a framework in which the ingenuity of the Indian people would prevail in creating leadership positions in manufacturing, in software. We again have world-class manufacturing in generic pharmaceuticals, etc. So I think the budget is a right step in encouraging investment, in fostering creativity, etc. And what the government is going is, it's concentrating on the right areas. It's trying to concentrate on infrastructure. It's trying to concentrate on housing. You know, they're building about 1 crore housing for people below the poverty line in this budget. They're trying to give incentives for low-cost housing. They've increased the outlay for MNREGA. So eventually in a society, when you have free markets, one of the things it is important is that as the country prospers, even people who are below the poverty line, the government pays particular attention to it so that there is acceptability of a free market system of governance. Otherwise, over a period of time, the government will face pressure to probably increase taxes for the private sector, which has its counterproductive effect basically on capital formation in private hands. So I think what the government has done is a step in the right direction.
Right. Rahul, would you sort of agree with that? Because before I get to specifics, I wanted a quick verdict, as it were, on what you've made of the budget. So very quickly, it's been a please-all budget. And, would you sort of agree with that? And the point that Shankar was making, that perhaps the enhanced public capex that we're going to see is going to have a multiplier effect, and we will eventually see, capex pick up on the private sector front.
At the risk of repeating what has gone on before, because the audio has just come on for me, I would suggest that, yes, I think that this budget was very much in keeping with the framework that was put in place by this government when it came to power. And it's very consistent. I was actually a little concerned that the fact that the elections were coming up, that the government would sort of veer off course and become populist. And try to sort of, please people in the short term and compromise the medium and long term. But I'm very glad to see that they've not done that. So I think full marks to the government as far as that is concerned. Two, I think that if you look at the entire policy framework, whether it's ease of doing business, because I think the government correctly recognizes that the only way we can become a wealthy country again, and to Shankar's point, I agree. We were 23% of world GDP as recently as 1820. So, we have been one of the richest countries in the world for most of history. So it's very important that we try and figure out what we've done wrong in the last 180, 190 years and try and regain our place in the world that that is rightfully ours, in my view. And I think the government's doing all the right things.
So let's actually,
if you think of specific
yes, I wanted to actually, if I could just get a word in. Yes,
go ahead.
I just wanted to talk about some of the specifics, and since you're talking about the government, fixing some of the wrongs, let's talk about something that impacts you, PE folks especially. The decision to do away with the Foreign Investment Promotion Board. About time that we saw this administrative cleanup, would you say?
Look, I think it's a very good step in the right direction. I just do hope that it's not a step in terms of moving it from one foreign investment board and then moving it to some other ministry, but it's actually going by a rule-based system. If you follow these certain rules or in these industries, you have an automatic approval. If you don't, there's no approval. I mean, if it is in that paradigm, then I welcome it. If it's moving from one department to another, then frankly, it's just an organizational and a cosmetic change. I hope it's the former and not the latter.
Right. Fingers crossed on that. Shankar, let's talk about, the other big announcements we heard. The railways are headed clearly to Dalal Street on track. All three railway companies actually on the IPO track. Would that be a fundraising that will, you think, find participation from, say, PE players like yourselves?
See, eventually it boils down to the specifics of the companies. But one thing, I should take this occasion as a member of the council for private equity in India should say this government has been extraordinarily supportive of the private equity and venture capital industry, right from the finance secretary to the finance minister to CBDT, etc. They've been extraordinarily responsive to our concerns. Private equity in India creates jobs, it pays indirect taxes, it contributes enormously towards direct taxes. We employ a large number of people, and to a certain extent, we act in some ways as a catalyst in transforming some of these. And I must say this budget has clarified some of the confusion that was there on the indirect transfer provisions. And apart from that, throughout the year, we have had an administration that has been very sensitive and very receptive to any logical suggestion that the private equity industry has made. And we should give a big thank you to the government for that. And I think this will help attract enormous sums of money into our country to invest and grow the economy.
You didn't answer my question on the railways, but I'm going to, sort of repose that question and make it a slightly broad-based one to Punita. Punita, let's talk about the divestment target at 72,500 crore in FY18. That's ambitious. It's 60% higher than last year. And, let's be fair. We know that for the last 7 years now, the government has missed the mark when it comes to meeting that divestment target. What is giving it the confidence this time round?
Mm-hmm. Well, the equity markets have been buoyant, so I think that's probably one source of confidence. But having said that, I think I would reiterate what you said, that the targets have not been met in the past few years, and the targets have always been aggressive. And while there are lots of new pools of capital, and perhaps private equity will take a bigger share of some of these new offerings, I think the foreign portfolio investors are going to be driven a lot by what happens globally and not just by what happens in India. And I think to that extent, what happens with President Trump's policies in the US can have an impact on all global markets, including India. So to that extent, the appetite from investors will drive whether these targets are going to be met or not. So the domestic investors will have to step in, and to that extent, I must say that with interest rates on a downward trajectory, with in the budget certain policies that are going to be better for financial assets, in terms of moving fixed assets into financial assets, there have been some announcements which will help drive more funds domestically into financial assets. So I think that will probably have to absorb a lot of these offerings rather than depending on foreign capital. And you must realize, obviously, as you do, that the foreign portfolio investors are already overweighted. They sold a lot after demonetization. They were concerned about India. They're probably going to come back because they're probably not as overweight as they were going into demonetization. But they're also going to be looking at companies depending on the earnings that the companies are delivering. And so I think some of these may be long-term strategic kind of divestments that PE firms might be more interested than just foreign portfolio investors, and domestic investors will have to step in if these targets have to be met.
Rahul, I'm just curious to know, IRCTC, for example, it's one of the largest ticketing agencies that we have in the country. Do you think it'll manage to fetch valuations that are, say, comparable to other e-commerce firms like a Red Bus or a Make My Trip? Or will it sort of face these valuation discounting overhang, due to its PSU heritage?
The real issue, and that is true for all infrastructure investing, and it's true for a lot of government-owned companies, there is lack of clarity whether its role and that it sees itself is that of a profit maximization role, or whether it sees itself as a utility which must generate a certain kind of return. I don't know whether you remember the Bimal Jalan Committee on Exchanges, which they did a study, and they classified things like an stock exchange, and they said that this is a utility and it must yield essentially what the government securities yield. Now, the difficulty in pricing such instrumentalities is that would that be a fantastic asset? It is, because it effectively has a monopoly on booking of railway tickets, and it's has immense amount of pricing power and immense amount of adjacencies. But the issue is, will the government system price it in that way and look at it in that way? And I suspect not. And therefore, it will be priced differently, is my view. And similar to a lot of the government-owned assets, because unless there is clarity as to what its role is in the system,
Right.
You're going to have discounting in pricing. It's similar with the oil marketing companies. It's similar to lots of the other public sector corporations.
Yeah, actually, Shankar, please do come in on
and I think that natural
Yes.
monopolies
Yeah.
government retain.
Right, Shankar, I just wanted to draw you in on the conversation because Rahul talked about oil, and we also know that the government wants to create an integrated PSU oil giant. Does that in any way re-rate the energy sector? I'm asking you because Carlyle Group does have presence in the energy space through Magna Energy.
See, eventually in each of these, any investor, like Rahul pointed out, is looking to make a return on his investment based on the risk he takes. If it's an equity investment, the risk is perceived as higher, so people look for a higher return. So none of us come with any kind of ideology saying that we should do this or that, but what we essentially try to focus is on the granular specifics of each investment. So if it is a ticketing company, we see what is the arrangement into, say, the government, how is its future going to be, is profit maximization an object or convenience to the public going to be objective. And the same thing is for the oil companies, because the oil companies in India, were partially privatized, IOC, BPCL, HPCL, and ONGC, and a lot of their shareholders probably would have benefited a little more if it was a completely private business. But because the government had the majority, etc., at times probably the decisions taken were probably with overall context in mind rather than the narrow interest of the shareholders. So things like these tend to attract some kind of a discount because investors eventually want to make a return on their investment. And so eventually in each of these cases, it is the specifics pertaining to each of these deals that would matter rather than, some kind of all-encompassing idea that, look, this is going to be a good idea.
Punita, I know lots of ifs and buts, when it comes to PSUs and investing in them. But would you still argue for a case that perhaps it's time investors took a fresh look at the PSU space? And I'm saying that because if you look at the CPSE ETF just last week, in 10 days, it's delivered something like a 9% return to investors. The government set out to raise some 6,000 rupees, but it actually it got bids for some 13,000. So from a stock market point of view, we've also seen PSU stocks rally in the last couple of days. Is there a case to be made for, investing in that pocket of stocks?
So, like Shankar and Rahul are obviously focusing a lot more on specifics, but talking broadly from an equity market perspective, there has been, over the last 5 years, there has been many portfolio investors who've talked about or wished that the oil companies would all actually get merged, and there could be one oil company, and that would really perhaps to some extent, improve synergies and create better synergy for companies to work together and being less competitive, and also maybe increase free float. So there's been a lot of arguments in favor. So to that extent, I think this by equity investors, this will definitely be welcomed. And also on the ticketing company, while there are a lot of specifics to be worked out, I think if one works with the government and gives them enough recommendations, this can be set up such that it can be a huge value creator for investors as well. And we've seen what Make My Trip has done, we've seen what C-Trip has done in China, we've seen these online ticketing agencies around the world have very high valuations if they're structured properly. So I'm more optimistic about both of these investments from an equity market investor. And then PSUs, again, you have to look at it sector by sector, company by company. I wouldn't say that there is anything that in the budget that necessarily says that PSUs should be re-rated, other than the fact that the government, because they are owned by the government of India, and the government is thinking in the right direction about the country, and the government is thinking about governance in a better way as reflected in the budget. One can argue that the valuation discount given to the government's functioning should be reduced. So I think that's one argument one can make, is that the government is going to function better. But I think you'll have to look at these individually.
All right, I'm afraid it's been a race against time for us on this special edition of Smart Market. So I'll have to say thank you to each one of you. Thank you so much for sparing time for us. We'll, of course, pick up this chat for another day. Thanks so much. Of course, we'll say goodbye on this edition of Smart Markets as well. Don't go anywhere. Next is The Verdict with Sandeep and Supriya.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.